Hi, and welcome to Crypto Cash Army. I'm Captain Crypto. In today's video, we're going to discuss the Harmony One crash that wasn't just the Harmony One crash. Bitcoin crashed and just about everything else did. So why did it happen? Let's try to find out. Before we go any further, I'd like to take a few seconds to say thank you to everyone that is supporting the channel. If you're not already a subscriber, please do subscribe and smash that like button. Again, thank you so much for being here. Let's get into the video. Hi, and welcome back. Like I mentioned in the intro, I'm going to try to explain what happened yesterday. If you follow my channel, you'll know that one had a considerable flash crash yesterday. It started out today about 13.1 cents, went up as high as 15.2 cents, and then crashed to as low as 11 cents. But one isn't the only coin it happened to. In fact, it happened to almost all coins in the top 100. So I'm going to try to provide an explanation as to why this happened. But first, the obligatory 5-second disclaimer. And we're back. Now I'm using the one chart to help explain what happened yesterday, but it could just as easily be any altcoin because most of them did fall. Bitcoin fell about $3,000, and most altcoins fell anywhere, if they were lucky, only 5%, between 5 and 20%. Now, before we get into talking about yesterday, though, I want you to look at May 4th, and that's this candle right here. You can see here we had a major drawdown too on one. And then, of course, yesterday, you can see it went up as high as like 15.2 and dropped as low as about 11, almost. Now we're going to take a look at the Bitcoin chart. If we look at May 4th, we can see we have a big red candle there. And then on May 10th, the same thing. Now, is this a coincidence? No. One is still very coupled to Bitcoin, as are most altcoins. Now, a few altcoins can still perform relatively well when Bitcoin doesn't do so good, but they're few and far between. So now that I've mentioned those two dates, the 4th and the 10th, which of course was yesterday, we want to look at a couple of things. First, we're going to look at the Ethereum liquidations, and this is for the 10th, which was yesterday. You can see that almost 300 million in longs were liquidated. Now, if you're not familiar with leverage, you may have seen it being described as trade up to 5x, 10x, 100x. Basically, what it means is you can put in $100, and if you enter a trade with 5x leverage, it's like you're trading with $500. And a lot of people do it. And the problem is that many people who do it have no idea what they're doing. And it can be quite dangerous, but I digress. So let's look at Bitcoin. Bitcoin had about $300 million in longs. Now, before we continue, what happens when a long position gets liquidated? Basically, the exchange takes your equity, the amount you risk, and sells it to cover the loss. And they'll generally do that before it goes all the way to zero, your equity. So when $300 million of longs gets liquidated in Bitcoin, and then another $400 million of longs gets liquidated in Ethereum, it's going to have a fairly substantial impact on the entire market. In fact, if we look at this Cointelegraph article from March, it covers how Bank of America did some analysis and determined that it took just $93 million to move Bitcoin's price by 1%. So if there were $300 million in long liquidations, meaning the exchanges themselves sold those positions. So they sold $300 million worth of Bitcoin, and they sold almost $400 million worth of Ethereum. And if we consider Bitcoin only, that means the market should have moved down essentially 3%. Bitcoin's value should have went down 3%, but it wound up going down more than that. Now, what caused the liquidations? Liquidations were caused by whales. The whales saw that Bitcoin was stagnant and wasn't really moving down. The whales want Bitcoin to move down so they can buy more, so they can accumulate more Bitcoin. They're not ready to let it go to the moon yet. They don't have enough Bitcoin. They want all they can get. They want your Bitcoin. So if they want to cause a fairly steep correction or price drop in Bitcoin, they don't have to sell a lot. If a few of them get together, collaborate, whatever you want to call it, and sell $200 or $300 million worth of Bitcoin, knowing in a few days, just a few days, maybe 2 or 3 days later, they're just going to buy it back at a cheaper price, they're going to do it. They determine when there's a lot of longs. And even though this is not so big compared to other days where they sold 750 million or liquidated 750 million worth of longs and more than 3 billion worth of longs, $300 million in long liquidations is still enough to move the market downward. And that's what the whales did. They probably sold 200 or 300 million, just enough to liquidate the traders that were playing on high leverage, 10, 20, 50x maybe. And then once the exchanges started selling those liquidated long positions and dumping them on the market at market prices, they just sell it for whatever they can get so they can recoup their loan to the investor. It causes a cascading avalanche effect. And that's what happened yesterday. Now, I'll show you what I mean by the liquidation. Now, this is liquidations for Bybit. And if we go back here and look at the liquidation chart on Coin Analyze, you'll see that Bybit has the highest dollar amount in liquidations because they're pretty much the de facto trading site for investors or traders that really like to use leverage, even more so than exchanges that are much, much bigger like Binance. So if we go back to this chart, you can see that on May 10th, this is just Bybit only, just the Bybit exchange by itself. They had almost 2 million long liquidations. And Bybit is not nearly as big as Binance or KuCoin or any of the major exchanges. So they have to sell those liquidated positions. They can't absorb them. There's just no way they could absorb that. And if you need further evidence that the whales were responsible for causing the liquidations, you can see from this chart on CryptoQuant, which details all stable coins in the exchange reserves. You can see a few days before and right after the May 4th flash crash, a lot of stable coins flowing into the exchanges. That's the whales getting ready to rebuy. And when they did, the price recovered. When they forced the liquidation, the price went down to 53,000. They come in, they started buying again because they were buying them on the cheap, and the price went up to 57,000. Same thing up here. Just a couple of days starting before this May 10th flash crash, stable coins flowing in. Now, what's that mean? That means over the next couple of days, you should see a Bitcoin price increase. How much? I don't know. How long will the higher price last? Again, I don't know. If the whales detect a lot of greed in the market, a lot of people longing positions on Bitcoin and Ethereum, then you'll probably see the same thing happen. They'll sell a significant portion. For example, let's say they want to push Ethereum down. They sell a considerable amount at 3,900 or 4,000. They push the price down to 3,500. They buy back in and they buy more Ethereum. They use the $3,900 or $4,000 they sold one ETH for to buy 1 point something ETH and increase their position that way. So it doesn't take a lot to understand why they do it. They push the price down so they can accumulate more Bitcoin and more Ethereum. And it's almost completely because of long leverage trades and people not setting stop losses or gambling like during a casino with crazy high, 10, 20, 50, 100x trades. If you're new to crypto, if you see an option to do 1, 2, 3, 4, 5x, don't do it. And even if you've been in crypto a while, you need to think long and hard before you go 10x or 20x or anything crazy. Because not only do you risk losing your equity in your investment, you risk pushing the entire market down. So in a word, leverage, long leverage, don't do it. Especially when the price action looks like this. I mean, just barely moving up or down and just moving completely sideways for the few days prior. Why would anybody open or maintain a long position on Bitcoin when the price action is like this? Why? It doesn't make any sense. But that just shows you we have a lot of inexperienced traders out there. Now, is there something positive from all this? Perhaps. The fear and greed index has fell to 61. Yesterday it was 72. And that means investors and traders and buyers and everyone is a lot more cautious. Still not so cautious. It's still showing some greed, but maybe a little caution will win out. I hope so. Because when investors get too greedy, everyone suffers. They not only lose their money and get wrecked, they cause a lot of other investors to get wrecked too. So in short, in leverage, don't do it. Especially if you don't know what you're doing. If you don't really understand leverage, for sure don't do it. And even if you do understand leverage, make sure you enable a stop loss, take a reasonable profit, and don't try to ride along to the moon, and just use some common sense. Well, anyway, that's all I've got for now. I hope you found something useful, and I hope you learned a little bit about how leverage trading can move the market, especially when it goes bad. But until next time, this is Captain Crypto signing off. I hope that you'll stay blessed and take care. Bye-bye.